joins in on the show then. Sunil, hi, good morning. Sunil, it's getting a little worrisome as to how the market is panning out just a day ahead of expiry. And from our chartist, I understand that it's a 9% OI build up on the Nifty, indicating that, there are a lot of short positions ahead of policy outcome tomorrow, Sunil.
Yes, and the rate hike is almost been, certain, because I think RBI governor himself said there will be a rate hike. So the only issue is about the quantum of the hike. The second would be in terms of what they plan to do on the liquidity front. And the third would be their own forecast for inflation in the coming quarters, which will give a sense of future RBI policy. So there's lots at stake tomorrow. And naturally, the market will be a bit nervous ahead of that.
Yeah, it sure is. But tell me, Sunil, I mean, we know a rate hike is coming. We've seen an out-of-turn first rate hike come in the previous time around in the month of May. What quantum will disturb the market? What commentary is something that the market doesn't want to hear, even though it's well prepared for a rate hike and we've made our peace with high inflationary and environment?
So I think it's more than just the rate hike. You see, the quantum, I don't see RBI going more than 50. So obviously, if they do 75, it will be a big shock to the market. I don't expect RBI to do that. But I think it's about the commentary of the future. You see, RBI gets a lot of data on hand which the market is not privy to. Right? RBI gets a lot of forecasts. They get consumer survey data in terms of forecasted inflation. And I think that's the key. The second is on the news on the monsoon, right? While we rely on this SkyMet and somebody says Kerala, it's arrived, not arrived, we'll see Bombay hit Maharashtra soon. But that's a big uncertainty. But if it's a good monsoon, then that's good news. So I think if RBI makes a comment about that on the data they have, that's the second thing. The third is that, as we know, RBI and the government have been working hand in hand. And the RBI has been able to influence the government to actually take some of the burden of inflation on their shoulders, right? You saw that in the petrol and crude. So if the RBI has generally been very supportive of the government in terms of promoting growth. But I think the government now is wanting RBI to support it more on inflation than growth. And that inflation versus growth, if the balance is decisively tilting towards inflation for the coming quarters, then that's not something the market would like, because cost of funds for all participants goes up, consumption will get hit because of the rising EMIs. At the same time, growth, the nascent growth recovery will start getting a bit cooled down in terms of forecasts. So I think that it's a commentary which is more important than the absolute rate hike. And that's where the deliberations of the MPC in terms of what we can expect in future policies are probably more important than what happens tomorrow.
Absolutely. And what we've also seen is that this is a DII's market, right? We've seen the velocity and the way the FIs have been selling. And with that, Sunil Subramaniam, while we're waiting to see what the RBI monetary policy decides with the inflation forecast, I'd like to take your attention to what we all saw on the front page of the Economic Times today. How India's contribution to the global market cap of equity markets is at a decade high, 3.1%. India is in the top 5 global markets as well when you look at market caps. It is talking about how this market cap increase has also been thanks to recent IPOs, whether it's LIC, Adani Wilmar, Delivery, Zomato, Nykaa. Sunil Subramaniam, when we read all of this and wonder, is this a bear market rally? Are we in a bear market trap? How to make sense of it? Because this is certainly a rise with India moment and how we discuss Indian equity markets.
And I think you've got to read this in conjunction with the fact that we have overtaken GDP of Britain, right, in terms of the size of the economy. So it's not just the market that India is, present in the world in an increasing space. It's also in the economy. And I think, so to come to the point of whether we are seeing a bear market rally, so I think there's one clear, thought process that everybody must bear in mind, right, is that none of this news, right, that's happening across the world, whether it's the Russia-Ukraine conflict, whether it's the rising inflation in the US and the hikes in rates, it's the oil prices, anything of them, is that Indian GDP growth rate is going to be in the high single digit, is not in question. Right. So the key is then why is the market so volatile? It's because of the liquidity factor, right? So the liquidity, even now, if you look at it from a liquidity perspective, India, though because of oil, we have seen bearing the brunt of the FI outflow in an emerging market space, still continues to have a huge premium to the emerging market in terms of its forward outlook. So there are short-term FPIs and a longer-term FPIs, and I don't see any move from longer-term FPIs to remove allocations from India. It's a shorter-term hedge funds who rely on borrowed money and hence are looking at the carry trade, who are pulling out the money. So for me, the current situation, right, ultimately is only reflective of a short-term knee-jerk reaction of a set of FPIs for whom, minor changes in interest rates and currencies deeply affects their portfolios, right? So from an India perspective, I see that we can ride this wave. Yes, inflation will rise in India due to imported inflation, right? But remember that in our CPI, almost 45 to 50% is food and only 10 to 15% of our food is imported inflation. So domestic food, so the monsoon is a key for the short-term outlook, right? But in the longer term, you saw the defense policy today about 76,000 crores of capex happening. So I think the government is doing a lot to support supply-driven GDP growth. It's the demand side which is not working yet, right? The pandemic has made sure that number of summers have gone past for the consumption industry. It's still not yet picking up. But the supply side, the growth of India is on a fairly firm footing due to three aspects, right? One is the government spend through either defense or infrastructure. The second is the PLI announcement, which means that all those factories setting up will lead to some capex and support growth. And the third is the fact that despite consumption not bouncing back, capacity utilization in India is back at the long-term average about 72. Right? So corporates, right, though in the short term their demand is not picking up to the extent they expected, are saying that 2 years from now I'll be out of capacity and are starting to build capex. So for me, that story is independent of all the Russia-Ukraine conflict or anything that's happening in the world, that India is on a firmly a supply-driven GDP growth. If demand comes in and supports it, we could even see it getting closer to 9% in GDP growth in a couple of years from now. So for me, the bear market, right? A bear market essentially reflects a economy slipping into recession. That's far from the truth. So for me, this is a period of volatility, right? Because of the flows and because of the news, and not a bear market as such. I don't see that the economy is in any position to become downtrend in terms of recession. So the fear of a stagflation, which is stagnant growth with rising inflation. Now in India, that stagnant growth is going to stagnate at 6.5 to 7, if at all it happens, not at the 2% or 1% of, or slipping into 2 quarters of negative GDP that the advanced countries are expecting. So our stagnant growth itself is the fastest growing nation in the world. So I think that we need to take a perspective around the fact that a nominal GDP growth of 12 to 15%, right, depending on where inflation ends up, is something that's going to make our absolute GDP grow, and the stock markets ultimately will recognize that. So I think that I would not like to call this a bear market. I would like to call this a volatile market while global uncertainties play out, and ultimately for the market to respect earnings growth from the Indian economy, right, reality will come in and support it. And I think DII flows being present is being allocated in those. That's why you see markets corrections are a little deeper, because not necessarily that the DIIs are buying everything that the FIIs are selling. Because the FIIs are selling what they already bought, which was safety, which was essentially IT, pharma, FMCG, right? But DIIs are buying a broader Indian space, and not everything the FI sells, they are eager to wrap it up.
And just taking forward that point, I see that in your top sectors, IT gets what, a contribution of 8%, and financials is nearly 29%. We've been asking our market guests, are you expecting IT to outperform in 2022? But when I look at this, I see you're relying more on banks. Yes,
absolutely. Because we believe that banks, being a large part of the market cap, larger market cap play, right, in the Nifty 100 and the Nifty 50, are naturally facing some selling pressure because FIs are selling across the board on the large cap. But from an Indian growth story perspective, a banking sector is critical for supporting the Indian growth. Not necessarily the same is true of IT. So for us, any selling in good quality banks is a good opportunity to buy. So I think that our bullishness around the BFSI space, right, remains intent because of the domestic centricity of that entire space.
Hi there, good morning. Where do you stand when it comes to the entire classic defensives, the likes of FMCG or even IT and pharma to that extent, because the general view is that when we see quite a bit of volatility in the markets, you can cushion that with exposure to the classic defensives. So what do you believe should be the ideal exposure to these spaces?
So we are underweight these spaces because what I want to say is that normally safety is defined as IT, FMCG in this space. And so in a volatile time, you tend to go to safety. But in the current situation, right, I don't think safety lies in safety, right? Safety lies in growth. So I would say that broadening your allocation with a domestic focus across the space, right? So I would still say consumer discretionary. I would still say housing and real estate. I would still say auto. I would still say capital goods cycle. These are all the spaces you should gradually be accumulating as there are drops in prices rather than go behind the traditional safety, because today the safety lies in the future growth. So I think there are allocations that you make to the potential for growth, and that the growth should come from domestic senses. And so IT could have growth if the US economy recovers, but that's a big if, right? So from that perspective, export-oriented growth, while the PLI sector and others would contribute there, they're not necessarily representative in the stock market. So I would say that for me, keep a domestic focus in mind. Look at where all this government spending is ultimately going to realize in terms of order books and downstream things. And those are the things that I would overweight in our portfolio today. And the traditional defenses, like you mentioned, IT, pharma, and FMCG, I would say I should be underweight them because I do not predict how much more FPI selling can happen. And if that so happens, the safety will actually correct even more.
Thanks much for taking time out and joining in, Sunil, giving us your view on the overall markets, the liquidity situation, as well as sectors.